Hi, welcome to our debate. Our question we will be covering is whether residential property is a worthwhile addition to an investment portfolio or whether you should hold pure investment in equity or bonds. This links to the SMSF study, as James O'Reilly's study shows property enormously failing over equity inside an SMSF. Due to the complexities and higher fees property faces inside an SMSF, we wanted to debate if his findings will hold outside of an SMSF and also cover many aspects that he missed. Presenting the affirmative, we have Alex Khabazian presenting argument points 1 and 2, and Oskar Wolffram arguing points 3 and 4. Presenting the negative, Max Glackin will be arguing points 1 and 2, and I, Wilson Sarkies, will be arguing points 3 and 4.
In this debate, we are arguing that residential property can and historically has been a worthwhile asset to hold, given the right demographic and market conditions. Our main arguments to convey this point of view is the consistent stability and returns that property has shown over the years, and its lack of drawdown and drawdown duration. Other points include diversification and market neutrality. And then we will also cover the sensitivity of property returns to economic factors and how property will look as an investment in the future.
In this debate, we are arguing the point that residential property is not a worthwhile investment vehicle to hold over purely investing in equity and bonds, based on both historical evidence and financial theories. Our main arguments to convey this point of view are the raw historical returns of equity, the customization of your portfolio, the ease of your investment, and the liquidity risk that comes with property investment.
Good morning, everyone. Let's start by looking at the equities. Now, equities are known for their volatility. As you can see in the graph, which shows the S&P 500 over the past 30 years, the average annual volatility is around 14%. What does this mean? Well, it means that prices swing wildly. For example, if your investment falls 50%, you need 100% just to break even. That's not a small change. And it's not just the short-term drops. The market experienced a prolonged 13-year period, showing the graph there, of low or negative returns between 2000 and 2013. Imagine holding your money through that and feeling the urge to panic sell. That's what behavioral risk looks like. Yes, equities are liquid and easy to buy, but as the graph shows, convenience with big risks, volatility interrupts compounding, and over the long term, that can seriously slow wealth accumulation. Next slide, please. Now let's turn to the residential property. Looking at the graph, it shows the returns over the past 30 years. Notice something important: property only experienced one minor negative year in 2020 during this COVID recession. Compare that to equities, property's annual volatility is just 3 to 5%. That's a huge difference. This lower volatility means compounding works year after year. Your gains build on each other uninterrupted. Plus, property gives you rental income. Even when prices don't grow, you're still receiving the cash flow despite the negative gearing. It's less correlated with market shocks, and it avoids with the panic selling and extreme losses we see in equities. This combination of stability and ongoing income provides a safer, more predictable investment for the long term. Next slide, please. Let's talk about leverage. With property, you can control larger assets safely. Unlike equities, you're not exposed to margin call risks that can force you to sell during downturns. And negative gearing provides a real advantage. If your expenses exceed your rental income, those losses can offset taxable income, which can go up to 47%. That reduces the risk of borrowing and improves your after-tax returns. Property also provides dual income streams, rental yield plus capital growth. It's largely market neutral, so it diversifies your portfolio and hedges against equity downside. Combine that with steady growth and tax benefits, your property becomes a very powerful tool for a long-term wealth accumulation.
Thanks for those points, Alex. Just the couple queries I would raise. One being the capital purchase of the house. I think it'd be difficult to raise the revenue, and I wonder how, as an investor, you're going to get the relative capital for the property. Not to mention the time it takes picking that specific property and investing compared to equities, where you can invest very small amounts of money into something diversified such as the S&P 500. And I guess my only other point, just looking at your slides, looking over negative gearing and how that might change over the next 15 to 20 years with legislation, and whether that's still a tax advantage to your investment strategy. But just moving on to my points, I think our equities, the historical returns, looking at the S&P 500, are really high. There's only a few years. The dot-com bubble just after 2000, there were three years of negative growth, I think. But beyond that, it's all very positive, up around the 10% margin. And then if looking at the long-term returns on property versus the S&P 500, we can see a very high yield for returns. The other point, we're looking at is the customization of equities. So the affirmative team, when buying a house, they have a range of houses to buy, but they're all the same resource. And for us, being an equity, we can choose a range of whether it be a treasury, bank interest, moving on to investments and whatnot, yielding a higher return. We can pick our own risk ratio where we want to be, and then organize a portfolio that suits us depending on the time of the year or how the markets are looking. So I think housing's more of an all-in, where you don't have money, you don't have room to move when issues arise. And then, not to mention our equities, we can include short positions or different derivatives to position ourselves in a safe spot where we need to be, and then we can look to advance later in the year. But thank you.
Thanks for that, Max. Two things I wanted to cover that you mentioned. First is when you're talking about the raw returns. I saw in your graph that you used, when you look at the cumulative return, you have to take into account that is the unleveraged return of the property capital growth. And when you look at and take in the drawdown just after the GFC, they're actually equal in the cumulative return. And when you account for leverage, you can have 80% LVR. That means that our cumulative return would be 5 times that. And then going on to customization, you do make great points there. But when you do that, it's often that you have to invest in funds and managers, and that introduces fees. And you can also have more idiosyncratic risk. You have to do more research. And in the long run, it won't beat the S&P 500 anyway. And going on to our points, first of all, I wanted to talk about the stability quickly, building on what Alex said. Here we can see housing price growth against interest rates. And here we can see that it only goes below 0 once. And while it does show volatility, it's always positive. And that's a good kind of volatility. When you have good upside risk and no negative loss risk, that's exactly what you want out of an investment. And you can see now, currently, we have really high property growth. and you can see that interest rates are on the downturn, and under more responsible monetary policy, they're going to stay around the 4% level that we see after 1994. And now, if we looking at rental yields, that's sitting at about 5%, and our CBRE real estate forecasts this to grow fairly significantly in the next 5 years, as well as vacancy rates falling quite significantly. And that's just going to increase demand. And you can see that KPMG also forecasts house prices to rise as well over the next 6 months. And another important factor to consider is net migration. You can see it takes a really large spike in the last couple of years. And you can see that new dwellings, supply of new houses is going down. And this further amplifies the supply issue and might suggest that these really abnormal returns that we've seen recently might, stay higher and benefit our case even further, whereas it might not just be a reasonable, safe investment, but a proficient, safe investment. Unless the government made some big changes to regulation, with this issue at the moment, it looks like the property growth is going to remain strong.
Thank you, Oscar. You raised some good points. The main thing I have to say regarding that, and you touched on it a bit, saying unless something changed regarding the current system, the systemic issue shown in your future outlook is something that can't just sit there untouched by the government. The overpriced housing and the kind of risks that this shows that's going to happen, that it could cause a little bit of a blow up in the next 5 to 10 years. It's a topic of fierce debate at the moment, and you cannot base predictions of future capital appreciation on a problem that may or may not fix, and you can't just hope that it doesn't get fixed, that being the reason for your investment. On top of that, the ease at which you can liquidate your assets when investing in equities is a key aspect when choosing your investment channel. The downside to property investment is that to realize your gains, you have to sell the entire property. Whereas selling equities, you can sell a portion of your equities and you can keep a portion of your equities. This is very beneficial if you're not looking to use that cash for something. If you were to sell the whole property, you would have to be using that cash. Otherwise, you have an opportunity cost of whatever's left over, and you'll more than likely end up investing it into equities anyway, as you can't afford a new property. By investing in equities, you have the ability to realize a portion of the investment, and this just creates a total ease in the investment. Next slide, please. The ease of both the initial investment and any future investments is valuable. By investing in the S&P, you will see a return based on historical data exceeding 10% for little to no time or research, as you can just turn on your computer, deposit money through the brokerage, pay a tiny brokerage fee, and then purchase the funds, all from the ease of your own home. Whereas in a property, you have to research regarding area and specific property, and then you also have to wait and hope an offer gets accepted. It also requires no time for maintenance during this investment period, as all you have to do is monitor the price to reinvest or to realize the gains if you feel the time is right. Whereas a property investor, they have to continually maintain the investment, both in the aspect of keeping the property livable and ensuring there are tenants in there to ease the cost of the mortgage.
Hi, Wilson. Thanks for your points. You mentioned that equities are liquid, easy to buy, and require no maintenance. That is true, and shares are quite convenient. But liquidity doesn't protect you from market crashes or long periods of negative returns. You might be able to sell quickly, but if the market is down, selling in locks it makes big losses and disrupts the compounding. And yes, property requires maintenance, but that's not a cost, it's an investment. To conclude, residential property delivers stable, predictable returns with lower volatility, consistent rental income, and dual income streams. Responsible leverage and tax benefits like negative gearing enhance after-tax outcomes. Compared to equities, property avoids major drawdowns, compounds with wealthy steadily, and provides long-term security. Thank you.
Overall, both historical data regarding the returns as well as relevant theory regarding financial markets shows how property is not a viable option to hold as an investment vehicle, and investing solely in equities/bonds is a much better option. Through our points regarding historical data, customization of a portfolio, liquidity risk, and ease of investment, you can clearly see how the arguments about property come with too much downside to make it viable. Thank you.